This week, the Federal Reserve is expected to raise interest rates for the first time in more than 9 years. The expected increase, a quarter point. For more on what this means, we turn to CBS News business analyst Jill Schlesinger. Jill, so we think it is going to happen this week.
Yeah, it's almost certain. And here's why. The Fed slashed rates 10 times over 14 months till we got down to 0% during the financial crisis. That was an effort to stimulate the economy. Now, all these years later, what's happened? The economy's growing by about 2.25% a year for the last few years. We've got job creation. Unemployment's down at 5%. The Fed thinks it's time to normalize interest rate policy. They'll start this week.
If this happens, who wins, who loses?
Well, finally, some good news for savers who've gotten basically 0% interest on their checking, savings, and CDs. Borrowers could pay a little bit more for all kinds of loans, whether it's credit cards, auto loans. Mortgage rates are not tied to these rates, but they could go up as well. Investors could be kind of murky out there. I think stock and bond prices could be quite volatile in the next few weeks.
The global economy is slowing down a bit. There's some concern the American economy is going to slow down. Some economists think this is too early.
Yeah, these are people like Larry Summers, the former Treasury Secretary, and they even cite the fact that crude oil, which fell by almost 11% last week down to 7-year lows, that's a sign of the slowdown. Janet Yellen, the Fed chair, has said, look, don't worry about that. Things slow down. We don't have to keep raising rates. And if things speed up and we get inflation, we could raise rates by more than 0.25% and more often. So everything will be data dependent. We'll have to see.
All right, Jill, thanks very much.
Thank you.